Good afternoon, everybody. It's Christian Thwaites of Brown Janikowski. Thanks for joining us today for our July market update. So before we start this, just thinking about the investment returns that we've had so far. It's been really an outstanding beginning of the year, first half of the year in most of the markets. Most of the large indexes are up between about 16-17%. The sort of big outstanding ones are growth, which continues to do quite well. The energy sector is up 38%. So it's been, despite the worry about COVID and then the vaccine rollout and then the opening, and the kind of trips we've had along the way, that the stock markets and more recently the bond markets have really not faltered at all. And even on the international side, they're not quite as good as the US numbers. Europe is up about 11%. International, the big index, which covers all of the big international markets, so Europe, Japan, some in Asia, about 9%. And it's only really emerging markets, which is the laggard, that had a tremendous run in the fourth quarter of last year, but it hasn't been able to sustain it into the new year. But anyway, so here we are with quite a strong equity market and very decent returns behind us, and hopefully ahead of us as well. So the topic today is, is growth slowing? And we're going to spend a little bit of time again on this inflation debate, only because today we had some CPI numbers, which if we'd had them a couple of years ago, would have really stopped the market dead in its tracks. They were sort of way ahead of what most people thought and expected. But I think there's a lot of influences going on from the rebound of an essentially closed economy. And you've probably heard all about this debate. We've covered it in the blogs between, is it transitory? Is it permanent? We've obviously got people on having kind of fairly extreme views on that, like, all the way to it doesn't matter. Everything will be, back to normal soon, all the way to sort of slightly more hysterical commentary, which is that this is the onset of a big inflationary era. And I sort of don't believe that one either. And I think the truth is, as always, somewhere in the middle. But anyway, let's go through that to talk about where we are with the growth. First, just a couple of quick points up front. I'd say, first of all, that COVID is not over. We're open here in Marin. We've got one of the highest vaccination rates for a county in the country. Vermont has the highest state vaccination rate. But they're not overseas. There's certainly not, I think 20-25% in places like Germany, France, Italy, compared to our number, which is more like 60%. And also there's a big disparity, as many of you know, between the different states. So the most populous states, Texas, Pennsylvania, New York, and California, which are roughly 50% of the US population, have pretty high vaccination rates. Texas probably a little bit lower than the other three. But in some of the other states, particularly sort of in the lower Midwest, central part of America, the vaccination rates are pretty low. So it's not over. It's the worst is of course over. That's great, but it's certainly not something we can say is definitely and permanently behind us. Consumer is coming back. The retail sales numbers and all measures of the consumer confidence are pretty good. I think it's going to show up in services. There's only so many. We've talked about this before. So many new cars, bigger TVs, more computers, computer power, more things to work and fix around the house that can be spent on, and the pickup's going to be in services. But services is going to. It won't rebound in quite the same way as the goods economy, just because you can't go out and have 5 haircuts to make up for the fact that you missed 4 in a row. And it's the same with hotels, and it's the same with lodging and airlines and all those kind of service economies. So it will come up. The next kind of rebound is expectation of service. We're already seeing some of that around, but it won't be the kind of snap V-shaped recovery that you saw on the good side. Interesting that the fiscal expansion has sidelined. I mean, a couple of months ago, we were discussing it yesterday. This was all the talk. We had the COVID relief bill that got through. There was another big stimulus bill. There was, of course, the famous infrastructure bill. But it's kind of become sidelined. I think something's going to come out, and one is going to come through with some Republican support, and then there's the other one which will be just passed on a simple majority. And these are big numbers, but they don't seem to be worrying the market yet in terms of inflation or asking for more compensation in the form of higher rates. And it just seems like some of the political momentum has been lost a bit on this. So I might be wrong on this. It'd be a difficult thing to gauge. Sometimes they can come back fairly quickly, but there seems to be a big gap between some of these stimulus bills. Bernie Sanders yesterday was on the Senate Finance Committee talking about a $6 trillion stimulus package. Well, I can safely say that I don't think that's going to happen. And what the number is, and whether they get through it, get it through by reconciliation, which is going to get everyone angry, or whether they kind of get through something on the stimulus side, which has a broader appeal, remains to be seen. But kind of one of the sticking points is going to be, taxes and the size of it. But anyway, I think we can definitely say the fiscal expansion from the last 12 months spilling over into the first and second quarters this year is probably peaked, and there'll be kind of it'll have a less impact on the economy for the next 18 months or so. Employment, this is the critical one, because as you know, we lost 22 million jobs. We've made up about 15, 16 million of them, but there's still a large number of people who were working in February 2020 and are not today. What we're looking at is the participation rate. Labor participation rate's kind of a difficult statistic to track sometimes, but we do know this, that participation in the 25 to 34 age group and the over 55 is 56 million people out of a workforce of about 130 million, depending on whether you take the household survey or the employee survey. But it's now 51 million, and that age group is not insignificant. That's the group which has probably got childcare issues, with the over 55s obviously representing the grandparent issues. So this childcare and lack of school openings has been a real problem, and I think a lot of it means that participation, which has dropped off very quickly, because remember, when these people are asked by the BLS, the Bureau of Labor Services, are you looking for a job, and they say no, the conversation ends there. They go down as not in the workforce. They don't say, well, are you thinking of going back when you can find suitable childcare or home care or healthcare for people that need help at home. So they're kind of marked out of the workforce, and looks like they've just disappeared, but they haven't. I think they're going to start coming back, especially as the schools reopen. We might have to wait till September for that to fully be seen. So the June jobs numbers were good. They were 850,000. We've had since the beginning of the year 2 outstanding numbers, i.e. better than 700. 2 not so great, below 300, and 2 somewhere in the middle. So it's not been a steady up increase, but it does seem to be moving the right way, as is claims. And claims, again, have been distorted a lot by seasonals and difficult year-on-year comparisons. And right now we're going through the closing of the auto plants, which puts a lot of people into temporary claim status. But definitely the claims are now hovering in the 370,000 range. And at the beginning of the year, there were 700,000-800,000. And of course, last year they were considerably higher than that. So they are improving. The Fed is still very much on data watch. They adjusted their growth assumptions upward in the summary of economic projections, which they did in June, I think. Yeah, June. And so they're seeing that the growth is picking up. Inflation is picking up. They still think it's temporary. There is this talk of having a couple of Fed funds rate increases, which are essentially zero today, up to 50 to 75 basis points, which would imply 2 to 3 increases by the end of 2022. But these are just averages of what everyone thinks. They're not sort of a body of thought. They're just 12 individuals asked, what do you think it's going to be? So they've not been terribly accurate in the past, nor have they been a particularly good guide to what the Fed is going to do. It's just kind of an idea that they think, well, within about 18 months from today, the Fed funds rate should be a little bit higher. Interestingly, although they marked up their growth estimates for the year, their long-term growth estimates were unchanged, and they, rather dispiriting actually. They talked about this being a 2% economy. back over the long term, but maybe they didn't give a lot of thought to that particular projection. But they're confirmed that they're watching inflation. I think this is why we had the big bond rally recently. You know, people thought, well, maybe they don't care about inflation, or they're just going to let it run for longer, or they're going to use this average inflation marker, which would imply that they'd let inflation run at 3 to 4% for quite some time to make the average closer to 2. But I don't think that has eased off a little bit, and they are talking about some tapering. Tapering in this context just means that they've been buying $120 billion worth of securities every month, and they will taper that off. You know, whether it goes to 110 or 100 or 90 is not really material at this point, but they are going to sort of, you know, at some point think about buying less. So that's kind of where we are. You know, generally things are improving across the board. The Fed, which some people thought was getting a bit wayward and a bit inflation negligent, is not. And so the markets over the last month or so have been pretty robust. Let's just kind of go back to the COVID cases. And again, this is where we were in January. So things had peaked. This is only from September. It probably peaked earlier than that, back last summer. But obviously this was the scare coming into the new administration. And then since then, it's obviously gone all the way down. And here we are right down at the bottom with everybody else. You know, this is, it's difficult to see at this level, but it's like, you know, 5,000 7-day rolling average of cases 5 per 100,000. So I don't know what that is in the US, probably like 10, 15,000, but way down from its peak. So, you know, this is good improvements all around here. Slight upticks in France and the European Union for probably just as more people sort of get out and there's a bit more travel. United Kingdom one is interesting. This is the Delta variant. And this is quite interesting. I just came back from the UK and they were getting very worried about this. And here are some numbers. So the Delta variant is, this is the percent of cases which are Delta variants. So in the US, and if the US is about half the cases right now, but look at these guys, they're up at the 99, 100%. So this new variant, even though you've got a very strongly vaccinated population in the UK, the number of cases which have switched to Delta variant is incredibly high. This is the difference, though. It's led to more cases. You can see the swing up here. This is the UK, but it's probably true in the US as well for the Delta variant. This is the number of cases that spiked up, but you know, luckily, thank God, vaccine and everything else, the cases and fatalities is almost flatlined. So what that means is that the COVID Delta variant is hitting people, but it's tending to hit the younger people who are unvaccinated. And so they have less comorbidity and probably with some herd immunity or maybe some vaccinations, they can have a less extreme case of COVID, which obviously makes sense because if they had an extreme one, the hospitalization rates would be going up. So yeah, this isn't, you know, if I was Boris Johnson right now, I wouldn't be too confident about this, too happy about this, but it does tell you that, you know, it's a slightly less severe form, and I think that's the case we're in now. I think I read that the Delta variant has a infection rate. I'm maybe not using the right term, but it has a potential to affect people up to 6 people, whereas the regular COVID is like 2.1, and obviously you want to get it below 1. So this is, you know, that's why I kind of say that in the COVID isn't over. And I think some of the recent concerns about the market, especially the general economy, global economy, is that, you know, we might be dealing with these types of outbursts from time to time. This is the US population. This is obviously pretty good, 38% of the population, you know, in these 4 states. We've got 160 million people vaccinated out of a population of about 320. And is 60% of the population over 18. The little tick up here in Florida was, I think, almost, well, we know that it was all unvaccinated cases. And I suspect, although they're not really terribly open with the numbers, they don't show it by county. So you'd expect some counties, like Dade and so on, to have a little bit higher infection rates because of the opening up of the economy and more people coming together and more people traveling to Florida. I mean, it's obviously a big vacation spot. So that little uptick there, when I say little, it's it's almost doubled from about 8 cases to about 16 cases, again per 100,000. But it does seem to be somewhat containable. The rest of these big states are in pretty good shape. I haven't put Pennsylvania in here, but it's up there as well, down there as well. Okay, so just kind of switching our attention to the economy, we had one of the biggest. It's very rare to get a drop in nominal GDP. This is the green line. You get drops in real GDP, and of course that's called a recession. The might fall by a little bit down here, 73.23%, something like that. Another one in 0709 was a big one, of course, and here. But you very rarely get drops in nominal GDP. And guess what? We've had 2 of them in the last 15 years. I mean, I think the last one before that was in 1932 or something. So it's we've recovered. So we had this big drop in nominal GDP. So nominal GDP is just before you apply the inflation factor. And so the US runs an economy, which is right here, is $22 trillion. And it was about 21.5 before COVID hit. And on an annualized basis, it went down to 19. So $2.5 trillion disappeared from the economy on an annualized basis. About $600 billion of spending stopped just like that. And that's showing up in the real GDP numbers here as well. But the good news is we're back above where we were in the in nominal GDP, and that's definitely a landmark. And there's not many countries can say that. I checked with Germany the other day, and they're certainly not there, and nor is Japan, just because Japan's had years of deflation, so their nominal GDP is going to take forever to get back to what it was pre even 10 years ago. So the US is sort of in the vanguard here of being able to show that the increase in nominal GDP is back now above trend. Now, if you've taken this trend, we had just taken this line up and extended it, so just like simple, not perhaps not totally honest, but simple mathematics, just said, okay, if we just continued on this track, we would be in like 23, 24 trillion. So we've definitely lost some momentum, and that's showing up here in the real GDP numbers. But I expect that maybe in the second quarter, which will come out in another 4 weeks or another 3 weeks or so, maybe less than that. But we'll see that the real GDP number is above what it was before COVID. So we're kind of back. That's good. Sort of lumbering below. The GDP numbers have been revised, up and then down, and now down. So this last quarter, we got a straightforward print of 6.4%. That's the blue column. That's done and dusted. That's sort of in the locker at this point. The second quarter estimates are a 7.9%. Now they were as high as 10% a year ago, but I think there's some economic indicators, numbers which came out over the last month or two, which have caused that to be revised down. The Atlanta GDP is just tracking a number of reports and updating the GDP expectations, probably about twice a week, hence the now phrase. It's literally telling you what's going on. This is for the second quarter, not for the third quarter, which we're in now. But anyway, growth has, leveled off a little bit from what people expected a month ago. But if we're back to 8%, it'll then slow off, let's say it's 8% for the second quarter. It'll start, clicking along at 4% for the third quarter, and maybe 3%. I mean, I don't want to get too precise about these numbers. They're, very, very, very big trillion dollar numbers, and you can, a couple of billion, you can be off a percent or two. But I do think, what we're seeing is a little less growth than we thought a month or two ago, but still pretty strong. Now, the inflation numbers. So I just made this chart. You can probably tell it's not very pretty. I apologize for it. But the inflation numbers came in today, and we and probably everybody else was saying, okay, we knew back in February that the inflation numbers, if the opening was on course that we thought it was, would start to tick up, just because the so-called base effects. Last May, June, July, things obviously had collapsed. So there was full-on deflation in a number of especially COVID-related economies, parts of the sector. I mean, your Apple iPhone wouldn't cost any less because it's not really affected, nor would your Zoom call or your Netflix subscription. But things that were dependent on you being out of the house, took a big hit. So we knew that just going into these 2 or 3 months, we'd get this base effect working against us, and we got a couple other things as well. But anyway, these are the ones. And so there's a month increase and yearly increase. So used cars, as I think we mentioned before, the rental car companies, especially Hertz, who's bankrupt, sold off its fleet last year, and then so it was a rental car company with probably 10% of the cars that it had in the prior 6 months, and then the demand for these rental cars came back, and so the used car prices shot up. Now, I don't particularly get concerned about used car prices because it's a finite number of used cars out there. I mean, if new car prices were going up, that would be a more worrisome concern, especially if you saw 10 and 45%. That means that the manufacturers were thinking about and able to get big price increases on new cars. But used cars are slightly different. If you need a used car, as some of you might need it, you might have been in this situation, especially if a spouse is returning to work, or a child's reaching a certain age, you need another car. But also a lot of people, as we've discussed before, are not able to use public transportation as much as they used to. A lot of public transportation, buses, trains, those kind of things are operating way below the capacity they used to. So there was this big demand for used cars, as well as the rental car companies coming back and saying, "Oops, we haven't got enough cars to rent." So the increase there was huge. Transportation generally, that kind of is everything, in trucks and buses and airlines as well. That's kind of come back. So yearly increase there. Gasoline, big one. A year ago is when we saw gas prices, oil prices certainly floating around the $10-12 route. And I think recently they're up to more like 70-75. So that's been a straight pass through into gasoline prices. Lodging is a little bit more muted. I thought that would be higher, but these are again hotels, motels, things like that, which where the increase has snapped back quite a bit recently. It's up 7% last month. This is for the June numbers, and 15% up a year ago. Food away, I would have expected to increase more. I think because obviously the restaurants closed and then they opened again. They've been talking about labor shortages, but the food away component has been quite tame. I don't know whether it's going to see an increase soon. I suspect not. I don't think many restaurants can afford to increase their prices very much. Shelter's the big one. Shelter is housing, and it's got this weird sort of description with the guys who run the CPI. It's called owner's equivalent rent, but this is 38% of the CPI index. So if this moves, the index moves. And that's up 4% on a year. That's somewhat reflecting the increase in house prices, not necessarily rents, but the idea is that rents follow house prices. So that's again a number which we wouldn't have expected a couple of years ago. I think it might dissipate just because the housing market has cooled off quite a bit. And then finally, airlines. I think I might be off on the airlines number. Actually, I think I might have missed a decimal point. I think the number's up 24% for. Yeah, it's up 24%. Sorry about that. I put 2.4. But again, that was an industry which closed down capacity and is now increasing it. And car rental. There you go. I've heard some amazing stories about people renting cars in Hawaii. Actually, there was a story about there were a bunch of U-Haul trucks lined up on the beach in somewhere in one of the Hawaiian Islands. Might have been the main one, but someone called in and said, "What the heck are they doing there?" And they found out the U-Haul guys were renting the U-Haul for tourists. They didn't need the capacity for the truck. They just needed a set of wheels. And so they were renting out something which would normally be used for moving furniture and stuff, as just a car rental company. So that's going on. And yeah, if you kind of Google it, you'll see some horrible stories about people being gouged for prices on car rentals and being charged cleaning fees when the car wasn't dirty, or being charged damage fees when there was no damage done to it. So the car rental companies are not above same way as, you know, the airlines and some of the others. So yeah, I think that will begin to stop. Here are some of them. So this is what I would call, you know, inflation COVID sectors. So here's kind of taken the index back to where it was in '01. So right now, airline fares, this car and truck rental has skyrocketed. It's 224% higher than it was in 2001. But you can see between, say, 2009 and 2019, there was no movement. You know, the car and truck rental business was just a sort of, pretty boring business. It wasn't able to put a lot of price increases through. In fact, this says it wasn't able to put any price increases through for nearly a decade. So this collapse and then this spring back is probably going to, not continue. And then the other one is the airlines. So airlines, again, if you take this decade, they increase prices and they decrease them, and then a massive drop off. But they're not back to where they are. You just got this big V-shaped bounce from 20 to 21. And I've thrown in lodging away from home and the used car numbers. But my point about this is, yeah, these are all often to the right, but they're not going to sustain that way because these aren't industries which are able to increase their prices at these sort of rates, and they haven't. Typically they've been fairly modest. Here's a few more. Insurance, collapsed last year. Insurance has not been a good business if you're in it, but not, as many of you know, your car and auto insurance doesn't tend to go down. Then it was flat for a while. Then it went way down as people say, well, I'm not driving, so I don't need insurance. And the insurance companies dropped their rates, and these have picked up again, but they're kind of back where they are. Lodging, we've talked about. Apparel has been coming down, and the airlines we've already talked about as well. So these are the kind of sectors which have got big moves in them. And I think you can see the connection here is that they're all sort of service industries which had a massive drop off in traffic demand, and they're reflected in their prices, and now they're coming back. So today's inflation numbers, well, this is the annual number, 4.45. This is the core inflation, excuse me, and this is the monthly numbers. So you can see, the headlines right now are, well, this is the highest inflation rate, monthly inflation rate since 1981. True. This is the highest annual rate since 1989. True. And the headline numbers are, would give the same number. The press doesn't tend to report this number. They report the headline numbers, but it's going to be a similar story. But I think, we have to kind of take more than a couple of months worth of data here and sort of, trust the fact that, as we saw in those prior examples, these aren't industries which can sustain price increases of those sort of magnitudes. They just would price themselves totally out of the market. So I think we've seen spikes like, not as much high as 0.8, but we not for a while anyway. But I think we just have to see that this is probably going to moderate. This is a very extreme move. Extreme moves tend not to continue. I mean, whether they revert to the mean, which is a bit of a cliche, I'm not sure, but they can't continue to go like that. Otherwise, there's just going to be, a complete fall off in demand. And I've also taken the PCE numbers. These are the blue numbers. So the black numbers are the CPI, which is the there you go. That's the number I was talking about. The 5.3 is the highest since 2008. The 4.4 is for more like 20 years. But this is the number the Fed's looking at, the PCE numbers, the 3.9 and 3.39, and that's definitely higher than what they would target, 2%. But I think my point about putting this is you've got a very long period of deflation, and if you stretch this number, this CPI number over many years, a century, 2 centuries, you'll see that the 70s stands out like a sore thumb. It's very unusual to kind of get periods of sustained inflation, which we had in the 70s for about a decade and a half. So I think the trend is still down, or low, I should say, this kind of 2 to 3%. But we got to work this out of the system. And this is kind of winded way of saying this is temporary. Temporary, I don't know how long. Not more than 3 months, but less than 2 years, and probably a lot less than 2 years. This is just the manufacturing, and this is where the the manufacturing and service companies are asked the question, what are you seeing about input prices? So if you're a manufacturer and you see that your I am very sorry.
Yes, you're back, Christian. Thank you. Sorry about that, everybody. We lost him.
Don't know what happened. Blame it on something. So I was talking about the inflation. Some of the inflation spikes are correcting, and this is the big one. You know, the lumber prices, which people were talking about a lot a couple of months ago, and I think we tried to explain that that was somewhat due, almost entirely due to the fact that there were, you know, very skittish house builders, didn't want to have a lot of inventory. Mills had closed down, or, you know, put a lot of workers on furlough, and of course the Trump import duties didn't help. So this is, you know, but lumber you can bring back pretty quickly, and there you can see it. You know, lumber prices were $1,700, and right now they're at $700, which puts them a little bit above. This is the price per 1,000-foot board. But you can see they've come way down. As are some of the supply issues. We wrote about containers leaving Los Angeles port full versus empty. And there was this big spike back here where there was a lot more, you know, empty containers in LA that needed to be in Shanghai in order to pick up stuff and bring it back. But that's eased off a little bit. So that's a good side. And then in the truck and rail, the trucking association is seeing, you know, tonnage is I think beginning to come back. It's this kind of flat for the year numbers, but that was, you can see the line here is coming back quite nicely, and the rail side never really had much of a problem, but they're increasing as well. So I think some of these supply issues are going to start to go away. I think we kind of talked enough about inflation. One of the things that, so I think a lot of it is that a lot of it's temporary, a lot of it's supply oriented. I think that picture is getting better. One big standout has been the housing market, which we've been tracking. Housing market now looks like it's rolling, and we've been saying that for about 3 months. But you could see it in the new houses, purchases of new houses and housing starts. And I think what's happening is that supply has stayed behind demand for so many years that the housing market has not kept up with the growth in the working population. It's as simple as that. So prices have rocketed outside of most people's ability to pay for them. And this is the highest, you know, I've ever seen this number. This is asking people, how do you feel about buying? Do you think it's a good time to buy a house? And 54% said no. So I think what we're going to see is a rollover in the housing prices, which will take a little bit of froth out of that market. We haven't seen many wage increases. These are in the leisure and hospitality side, 7%, 6% for retail trade, 6% for transportation and warehousing. But I have to kind of put these numbers a little bit with some care on them, because a lot of people fell out of the labor market a year ago, and the lower pays, even within these industries, fell out. So it looked like they had higher rates, higher growth rates. And I think some of that will settle down. This is not an industry, none of these industries are really going to be pushing up wages at 6-7%. It's probably settled down into the 4 and 5% side. And then the other one is the employee cost index. So, you know, average hourly earnings are up, as you can see, they're all over the place, but they're about 3.6%, but it doesn't necessarily mean that employee costs go up, employer costs go up, and they haven't. Now, these numbers lag a little bit. This is from the first quarter, so we're going to be, I think, looking at the second quarter any day soon. But they're running at 2.7%, and it simply means that if the hourly wages go up, employers might just compensate for that by giving them less hours. So it doesn't necessarily mean that the employer costs go up, and I think this is something we've got to watch. But there's a big disparity here. You know, the hourly numbers look like they're going up, but I don't think they are going up nearly as much as they look. And the employer costs are looking very moderate indeed. The job numbers have been, after a couple of, as like I mentioned, a couple of weak months, are now coming back. The unemployment rate is sort of a little bit artificially low at 6%, and I say that just because labor participation is pretty low. but the real unemployment rate is closer to this, about 9.8. This is the U6 rate, which to ask people, are you unemployed or are you underemployed? You know, not through your own choice. In other words, you've got part-time work or work which you would not paid enough, and you would normally work in something else, but you can't find it. So that's really the closer to the number that we're looking at. So there's still, you know, a fair amount of job creation to go. But if we click along at 6, 7, 800,000 jobs a month for the rest of the year, we'll be in very good shape, and the labor market will begin to heal quite a bit. This is the labor participation market, which I've touched on already. This is just the number of people employed as a part of the total population, the population above 18 anyway. So as we mentioned before, labor participation peaked up here. It's been sort of declining, especially amongst women. It then slowly came back in the decade from the 2009, that slow recovery plummeted last year, and now it's back up again. I don't think it's going to go back to 1981 levels. This participation rate is, as I mentioned earlier, with the caregiving age brackets, I think more and more people are going to come back into the labor market, and it's also distorted somewhat by young people who you know, may not have been able to find summer jobs this time around, and so that they're registered as not being in the workforce. So this will come back. I don't think you know, these people have permanently left the workforce. If they have, then that's a real problem, but I don't think they have. It just seems too much of a stretch to believe, and given all of the other circumstances which are going on, the healthcare, childcare, and changes in employment in different industries, that people are going to stay permanently outside the labor force. So that's going to come back, I think, with some strength. The jobs are out there. This is 9.2 million open jobs. You can see it's way above even the peak of the 2018, which was more like 7 million. It took a long time to climb back up. This has come back very quickly. There's roughly about, down here, about one job for every unemployed person. Now, it doesn't necessarily mean they're all in their perfect matches. They might be in the wrong place. They might be in the wrong professions. Might be openings in trucking and very few openings in medical care. I don't know, but so there's a. It doesn't obviously mean that, you know, everyone can walk into a job tomorrow, but it does mean, I think, that the demand for labor is out there and should stay, you know, fairly robust. There is a kind of a shift in the power balance, though, and I've talked about this in the blog, is that people who really had to take a job, you know, at almost any level, are getting a little bit more bargaining power. The quits rate, this just measures how many people quit their job. And as I mentioned, you don't really quit your job unless you're pretty confident that you can find another job, or you're moving, or you're retiring. But normally it's the first one that you feel that you can get another job. This peaked up to 3%. And normally this doesn't get anywhere close to that. So I think what's happening is that people are moving out of some of these jobs. And we, you know, I heard a very interesting anecdote yesterday. More than an anecdote, it was a guy talking about his whole company, 25 chains of hotels, and they're finding the people who they used to hire for, you know, cleaning and maintenance work, and mostly unskilled, you know, move to things like warehousing and trucking, which had and driving, local delivery, which had better hours, better pay. And they're moving more towards, now the hotel was moving more towards, you know, offering training and offering better hours, you know, shorter 3-hour shifts, so people could move in and out of childcare, or else, you know, providing them more with tools if they're working in the kitchens, or getting them their own, literally talked about giving them their own set of knives. So I think what's happening is that, you know, some of these lower paid jobs, people have found alternatives, and things like hotels and restaurants, which we hear about a lot, almost to the exclusion of everything else, are having trouble finding people. But I think they're going to have to moderate. So, yes, sure, they might offer a little bit more pay, but I think some of them have to change their employment practices as well, because right now in the lower paid area, there's quite a lot of bargaining power amongst people, shown by this quit rates. Now, the bond market has been interesting this year. We started about 1.7. You can see right now, actually it's a little bit higher today, but essentially went to 1.36%. So back up here, back in April, May, definitely the bond market was worried about too much growth and too much inflation. Now it seems to have been moderated a lot, and that's sort of borne out in the numbers. The inflation numbers are still there, but I think most people think, well, the growth rate's probably not going to be as high and as rapid and as as accelerating as we thought. And that's showing up. Yeah, the job numbers are coming back, but they're not coming back, in a V shape. Demand for services, all the things we talked about, hotels, and are coming back, but they're not coming back, in a super quick way. The supply and capacity strains are still at play. So the bond market is pretty sanguine right now. It's sort of saying that, well, maybe there's not too much to worry about inflation, and there's not too much to worry about, longer term bottlenecks in the growth markets. I'm going to skip over that one. Just to quickly talk about the stock market. So earlier in the year, we saw this is back from January, we saw this big outperformance of value stocks. This was the idea that the economy would be broad, very broad and fairly deep, and then value stocks, which are typically just a shorthand for banks, industrials, energy, and other type of oil, mining related stocks, would do very well, and they did. But I think since then you can see that value has flattened out quite a bit. And again, it comes back to this, well, the treasury number came down, the concern about growth ameliorated a little bit. Maybe we've sort of seen peak growth. We're not going to be seeing 6-7% quarters. They're going to go down to 3-4%. So in that case, value's kind of gone sideways, and this big gap here, when this line goes down, it means that value underperforms growth. When it goes up, it's the other way around. So at the beginning of in April, we had a big outperformance of value. Beginning of the year, we had a big outperformance of value, but since about early June, it's been growth all the way. And I think what's happening is that the value stocks are getting a little bit maybe expensive, or people maybe don't believe they can sustain some of this, and then people are willing to pay for growth, and so they kind of bid up some of the growth stocks recently. I would say that this is kind of a draw in terms of growth has been here. It's growth has outperformed value recently. Up here, value outperformed. Over the long term, it's pretty much no contest. Value stocks did well in this extraordinary period in 2001. This is just financials. But normally, this is why we sort of urge a little bit of a growth tilt towards equity portfolios, because growth generally has just outperformed value by a very long way. There's times when it doesn't, like in here, and a little bit in here, but generally, having the growth bias, which we do in our portfolios, pays off. We've also seen some changes here. Again, if the last time we met, here was small cap, way ahead, and it still is. But some of these are top. Look at this. This is the top 5 companies: the Apple, Microsoft, Facebook, Google, and Amazon. And they've gone from an index level of about 105 to 190. So about 12-13% in a month. So the top 5 have really taken off the growth again. I think this is people looking and saying, with the top 5 companies, I get good 10-11% compound growth rates, and an economy of 3 or 4 or perhaps less. That's a very good thing to have. So they've come back into their own. The only other surprises here is that emerging markets has kind of gone sideways. It's mostly a China story. Valuations got a little bit cheaper. This is one of many ways you can value the market. You can on P, on yields. You can do all sorts of ratios about explaining whether it's cheap or not. None of them are infallible. None of them are 100% reliable. This is sometimes reliable. All it does is just take the price earnings ratio and flip it, and tells you what a company's earning on its assets. You can compare it to a government bond yield. It's earning about 4.5%. And if you take it, so it's earning about a 3.2% premium over the 10-year. That's pretty much, the lower the number, the more expensive the market. The higher the number, the cheaper it is. So it's sort of in line here. There's really not a lot you can grab onto this to say that what we've said before, the market's not throwing off any bargains. It's not cheap, but nor is it outrageously expensive as per back here. So anyway, got a quick summary. The reopening, on track. I think, but before I put by July, that's probably still up there, but I think it's going to be, slow and gradual. I mean, not super slow, but it's not going to snap back super quickly. And we're just here in California reopening, and you can start seeing things like activity in travel and leisure, and more cars on the road. Consumers ready to spend, as we mentioned. There's some catch up in spending, especially in services. The Fed's going to track wages, but there's really not much for them to track right now. Because the wages aren't, the wages are kind of a little bit all over the place until they settle down and we see any changes in employment costs. I don't think they're going to get too worried about it. The fiscal expansion is definitely past its peak, regardless of whether these stimulus bills go through, and I don't think they're going to go through in the size that some people are talking about. The labor supply is going to come back slowly. I think, for now, we like the growth stocks. We haven't gone crazy on growth stocks. We haven't got a massive overweighting, but we have tilted the portfolio slightly towards that in the last month or two. I think, as I said, as the economy goes to a non 6%, 7% rate, let's say 4% for the rest of the year, the growth stocks will continue to be quite attractive in that environment. I think the Fed's Fed's signaling every day very, very clearly. They're going to tell us when they're going to stop reinvesting coupons on the balance sheet. Then they're going to tell us when they're going to start tapering, and then they're going to tell us when they increase rates. But we wouldn't look for anything for 2022. So here we are mid-year. I think we're in quite a good position. It's been a very good ride in terms of the capital markets. I think it's kind of steady as you go, and with the bond market yielding 1.42% today after the inflation numbers, is telling us that there isn't too much to worry about on the inflation side, which has been our thesis all along. I don't know if we have any questions, Carolyn. Is that?
No, it looks like we have no questions waiting for you.
Okay. Well, thanks everybody for listening in. Sorry about the technical glitch halfway through.
Good recovery, Christian. Good recovery.
As always, feel free to email us on the general number, or your FA or me at Thwaites@B&J Advisors. And I think we're going to put this up on the web if you like to listen to it at a certain time, and the slides will be there as well.
Yes, it'll be on the website.
Okay.
Are we ready for the disclaimer?
I can read the disclaimers. Is that helpful?
No, I think I'll just play the recording.
Okay, thanks so much, everybody.
Bye.
Bye.
Presentation is for general informational purposes only. References to an individual security should not be construed as a recommendation to buy or sell that security. The securities mentioned in this commentary are only several of the successful as well as unsuccessful investments by us, and do not represent all the securities we have purchased, sold, or recommended. Although we deem reliable the sources of statistics